You want to know what genuinely keeps me up at night because honestly, it isn't market crashes or even runaway inflation. It is watching hard-working people desperately trying to build a massive financial skyscraper on a foundation made entirely of quicksand. I see guys asking which meme stock is going to the moon while they drown in credit card debt, charging 24% interest. Let's be clear that this isn't investing, folks. It is actually just financial suicide that has been cleverly disguised as ambition. You are literally trying to fill a bathtub with a tiny teaspoon while leaving the main drain completely wide open. My name is Marcus, and I spent 15 years as a forensic accountant hunting down missing money for Fortune 500 companies. I have seen exactly how real wealth is built, and I have witnessed the exact specific behaviors that destroy it. I can tell you with absolute mathematical certainty that most people are approaching their financial lives completely backward. They chase the sexy returns like crypto and options trading because it releases that addictive hit of dopamine in their brains. Yet they completely ignore the boring and unsexy algebra that is the only thing that actually makes you rich. If you are tired of running on a hamster wheel where you make money but never actually keep it, you need to listen. There is a specific and non-negotiable order of operations for your capital that dictates whether you win or lose. If you violate this order, the math will punish you, but following it unlocks a level of freedom most only see in movies. Recent audits of the American wallet reveal that nearly 1 in 3 people couldn't cover a $500 bill without borrowing. That is less than a set of tires. Yet these folks worry about asset allocation in a portfolio they shouldn't even have. It is the equivalent of standing there worrying about the paint color on a house that is actively on fire right now. Before you buy a single share of stock or look at a ticker symbol, you have to secure the financial perimeter. Step 1 is the emergency fund, and I don't mean a jar of coins, I mean building a psychological firewall. All right, let's audit your safety net because you simply cannot call yourself an investor if you are one flat tire away from total insolvency. When I mention emergency funds, I see eyes glaze over because people mistakenly think cash sitting in a savings account is just dead money doing nothing. That is completely wrong because that money has a critical job, serving as insurance against life's chaos and your own potential for bad decision-making. Here is the strict protocol. First, you must scrounge up $1,000 by selling junk or working overtime to create your Stop the Bleeding fund. This fund exists solely to stop you from swiping a credit card when the water heater explodes, before you scale up to 6 months of expenses. I am talking about keep the lights on money, and pro tip, you need to park this cash specifically in a high-yield savings account right now. Do not leave it rotting in a checking account earning 0%. You need to force the banks to actually pay you for your liquidity. Data from Vanguard proves that holding just $2,000 in cash reserves boosts your financial well-being score by over 20% immediately. It is not just about the math, it is about removing the desperation that forces you to panic sell your assets at the very bottom of the market. Now that the defensive perimeter is finally secure, we must move immediately to the scene of the crime, which is your high-interest debt. I define high interest as anything over 8%. But the real villain is credit card debt, which currently sits at a national average of 22%. In my line of work, we call this wealth extraction, and carrying a balance while trying to invest is frankly mathematically offensive. Trying to build wealth while paying 20% interest is literally like trying to swim up a waterfall while wearing a pair of lead boots. Think like an investor. Paying off a 22% debt is exactly the same as getting a guaranteed 22% risk-free return on your money. You cannot find that kind of return in the stock market because not even Warren Buffett averages a risk-free 22% gain. If you carry $5,000 at this rate and make minimum payments, you will hand the bank nearly $3,000 in interest over 5 years. That is $3,000 of your actual life energy that is gone forever just to service a liability that you shouldn't have. So how do we kill it? People love the snowball method for the psychological win, which is cute, but I prefer brutal mathematical efficiency. I recommend the debt avalanche, where you list debts by interest rate and attack the highest rate with every spare dollar you possess. The math does not care about your feelings. So kill the highest rate first to stop the compound interest from bleeding you dry. I previously stated that high-interest debt is a critical emergency, but there is actually one specific mathematical exception to this rule. I am referring to the only moment in finance where you can secure a guaranteed, instantaneous 100% return on investment. If your employer offers a matching contribution plan, you must take that deal every single time, even if you have debt. By putting in $1 and having your boss match it, you achieve a 100% return before touching the market. Mathematically, a 100% immediate gain always outweighs a 22% interest loss, so walking away from it is negligent. However, you must read the fine print regarding the vesting schedule, which is essentially just corporate speak for golden handcuffs. If you plan on quitting in 6 months, the match might be an illusion, so you absolutely need to know your contracts. Once you capture that specific match limit, stop funding the 401k immediately because we need to pivot to the tax optimization zone. Most corporate plans are sadly bloated with hidden administrative fees and mediocre funds, and as an auditor, I absolutely despise inefficiency. This is why you switch to an IRA, allowing you to fire expensive managers and buy low-cost index funds on your own terms. In a bad corporate plan, you might pay 2% in fees, whereas in a private IRA, you could pay virtually zero. Over 30 years, that fee difference is not pennies. It is the difference between retiring in Florida or in your kid's basement. For 2025, you can shelter up to $7,000 here, but now you face the classic interrogation of traditional versus Roth. The decision ultimately boils down to whether you trust the government to keep tax rates this low in the distant future. With a traditional IRA, you take the tax break today, which is excellent if you are a high earner right now. With a Roth IRA, you pay taxes today, but the beautiful part is that you withdraw everything tax-free in retirement. If you are young, the Roth is the superior weapon because you pay taxes on the seed rather than the harvest. The most robust strategy is tax diversification, having money in both buckets to give you critical leverage against the IRS later. If you are still watching this video, then congratulations, because you are already statistically ahead of 90% of the entire population. Now I am going to hand you the Swiss Army knife of the tax code, known formally as the health savings account. Most people treat this account like a simple piggy bank for buying Band-Aids, which is a massive waste of its true power. To a forensic accountant, the HSA is the holy grail because it offers a triple tax advantage found nowhere else in America. You get a tax deduction when money goes in, it grows tax-free, and if used for medical expenses, it comes out tax-free. The IRS usually manages to capture you on at least one side of every transaction, but with this specific vehicle, they get nothing. Here is the strategy that separates the wealthy from the average. Do not spend your HSA money on medical bills right now. Pay for your doctor visits out of your own pocket today and leave the HSA funds invested in the market to compound. But this is critical. You must save every single receipt, scan them, and back them up because there is no statute of limitations. You can pay for an MRI today and reimburse yourself 20 years from now tax-free after that money has tripled in value. Once the HSA is maxed out, circle back to your workplace 401k and fill that bucket all the way to the top. You want to shelter as much income as legally possible from the taxman before you step out into the cold, taxable world. That brings us to the final step everyone wants to start with, which is the Wild West of the taxable brokerage account. This is where people go to feel like Wall Street traders, but they completely forget about the silent killer known as tax drag. In a taxable account, every dividend is taxed and every sale is taxed, which is like running a marathon with sand in your shoes. If you invest the same amount in a tax-advantaged account versus a taxable one over 30 years, the difference is staggering. You could lose upwards of $250,000 simply because you chose to put your money in the wrong bucket. Use taxable accounts only when you have exhausted every other option or if you need a liquidity bridge for early retirement. So there you have it, the official forensic audit trail for building wealth laid out in black and white. First, you build the firewall, creating an emergency fund so that normal life events do not bankrupt you. Second is the match, where you grab every single dollar of free money your employer is willing to give. Third is the detox, where you ruthlessly eliminate high-interest debt because it is a cancer on your net worth. Fourth are the shelters, maxing out your HSA and Roth IRAs to legally keep the IRS out of your pockets. Finally, we have the overflow, where you move to taxable accounts only after every other bucket is full. Now I am going to be brutally honest with you about why the vast majority of Americans never get past step 3. It is not because the math is too hard to understand, it is simply because the process is incredibly boring. Paying off a credit card does not give you an adrenaline rush or make for a cool story at parties. Everyone wants to brag about the stock that went up 500%, but nobody brags about a diversified index fund. But in my career, I have learned that in finance, exciting is usually a synonym for risky, while boring means wealthy. The people driving the flashy cars you envy often have balance sheets that are secretly bleeding red ink every month. The people following this boring sequence are the ones retiring 10 years early and owning their time, not just their stuff. You have a choice to keep trying to outsmart the market like a gambler feeding coins into a slot machine. Or you can respect the math and do the boring work today so you can live a life of absolute freedom tomorrow. My name is Marcus and I crunch the numbers so you don't have to, so please hit that like button. It is the best return on investment you will get all day because it costs you absolutely $0. Subscribe if you want to see more audits of the financial system. Class dismissed. Now go fix your balance sheet.